Good afternoon, everyone. Thank you so much for coming to Wintersession 2024. My name is Ty. I'm a community engagement specialist here at the Harvard University Employees Credit Union. We're very happy today to bring you a great topic, which is managing credit. This is going to cover basically any and all questions and things related to your credit score and how you can improve it. And we're going to jump right in. Couple of sort of housekeeping notes before we start today's webinar. I'm sure you're all very familiar with Zoom at this point, but a couple formats we're going to use with our presentation today is we're going to ask questions mostly at the end. We have a Q&A block reserved for time. Everybody is automatically muted, so you don't have to worry about making sound. You can feel free to eat your lunch during today's webinar. We're going to ask that if you do have questions live during the presentation, that you use the Q&A feature of Zoom rather than the chat. This is going to help us just make sure things stay a little bit more organized, as well as everything coming in from one place so that we can work on answering them as they come in or save them for the end. And also, just so you know, that our presentation, like all of our presentations, are recorded and they will be available for free on YouTube. That's my HUECU on YouTube. You can always rewatch them or share them with family and friends as you see fit. A little bit about us here at HUECU. We are a not-for-profit organization. We're a credit union. This is different from a bank because all of our members are part-time owners in the or partial owners in the credit union. We are able to give back a lot more of the profits that we make to our members in forms of fewer fees, as well as like better rates for certain things. We have a direct hand-to-hand engagement with our community and our members, and we really go out of our way to make sure that we work directly with all of our members to create the best types of products and accounts that work for everyone. And we also are very student focused. So just in case you weren't aware, every student at Harvard is eligible for membership here at the credit union. Once you are a member, you're a member for life. It doesn't matter if you choose to, once you've graduated Harvard or whatever it is, you can always come back and reopen accounts or open new products with us, as well as this membership extends to your family as well. We have great products that are designed for students and how to like build bank accounts, credit, all that sort of thing, as well as a lot of ways to reduce on fees for ATMs and a lot of other things. So definitely take a look if you want to stop by. We have our main branch right here in Harvard Square, and we'd love to see you. All right, and without that, I'm going to turn it over to today's presenter, Amber Miller. She works with our partner GreenPath, who will be taking lead on this presentation today. Amber is a partner experience manager with GreenPath Financial Wellness. She lives in Philadelphia with her husband and 3 cats. Amber is extremely passionate about financial wellness and has experience developing a financial education program during her time working for a community bank in Kansas, as well as providing credit and housing counseling at GreenPath. She's especially passionate about making the topic of credit approachable and is thrilled to be here today. So take it away, Amber. Thank you for joining us.
Thank you, Ty, and thanks everyone for spending part of your snowy afternoon with us. I really am happy to be here, and I just want to thank everyone at HUECU, Ty, Terrence, everyone over there for the invitation to join you all today to talk about, again, one of my all-time favorite topics to present about, which is credit. Something you may have not ever heard someone say before is that credit is one of their favorite topics, but there's so many moving pieces with credit, it can be difficult to know exactly what's going on. And so my goal here is to really break this down and hopefully make it feasible, easy to figure out what you need to do to get your credit where you want it to be. So GreenPath Financial Wellness is the organization I'm here with through our partnership with Harvard University Employees Credit Union. And GreenPath is a nonprofit organization with a mission to empower people to lead financially healthy lives, which we've been doing since 1961. GreenPath is a credit counseling agency certified by the National Foundation for Credit Counseling, and we are also certified by HUD as a housing counseling agency as well. So for more than 6 decades, we have been helping people understand and build credit, manage debt, obtain and or retain housing, and so much more. I, again, am really happy to be here today to talk about the somewhat confusing, but oh so important topic of credit. So, just to cover our agenda for this time that we're going to be spending together this afternoon, first of all, we're going to just break down some of the basics of credit, go through some definitions, really define what we're talking about with this. Then we'll talk about why credit even matters. This is a question that came through before our presentation started today, and the registration is, why is credit even important? We are going to talk about that. Then we'll dive deeper into what actually impacts your credit score before talking about how to build credit from scratch, which is another question y'all had ahead of time. So we're going to get through that, or rebuild it after a credit setback. And then we'll also bust some credit myths. There are a lot of myths out there about credit, or things that may be true in some situations and may be less true in other situations. So we're going to talk through some of those and why they're not necessarily true or aren't necessarily true for everyone. And then we're going to wrap up by just taking a look at some different healthy credit habits and tips to practice what we're going through here today moving forward. So let's go ahead and dive right into some of the basics of credit by, again, defining some key terms. So at its core, when we talk about credit, credit is an agreement between an individual and a creditor in which the individual receives something now with the understanding they will pay the creditor back later. Typically, but not always, that comes with some interest. The creditor says, hey, we're going to let you have this now, but we need to, charge a little bit of interest to cover our risk level and just make sure that we're getting something out of this. This can come in a variety of forms, maybe a loan, a credit card, a line of credit. Those are the most popular forms here of what this looks like. A credit report is what shows both your credit history on old accounts that you've had for a while or that you've previously had and have maybe closed, and the activity on your currently open credit accounts. So this shows just a history of how you have handled credit accounts in the past, as well as how you're currently managing those accounts you have open. Things can typically stay on your credit report for somewhere between 2 and 10 years, depending on the type of item, which we're going to go through in a little more detail here in just a few minutes. And perhaps even longer if the accounts remain open and in good standing for longer than that. If the account is open and active and in good standing, there's no real limit on how long it would remain on there, as long as that remains the case. There are 3 different credit bureaus that all generate credit reports. Those are Experian, Equifax, and TransUnion. There's a little bit of variation between these 3 reports in some cases because not all creditors report to all 3 credit bureaus. It typically costs creditors money to report to the credit bureaus. So especially some collection agencies, some smaller creditors, they may have, one preferred credit bureau that they're reporting to. So there can be some differences and variations across the 3 reports. You are, however, entitled by federal law to access a free copy of your credit report from all 3 credit bureaus. You're entitled to do this by law for free once a year, but during the COVID-19 pandemic, the credit bureaus started offering these reports for free weekly. That was expected to come to an end at the end of the pandemic, but they recently made the decision to continue this indefinitely. So you have access to your free credit reports weekly from all 3 of those bureaus. Weekly is probably a little bit too frequently to need to keep an eye on things. Things usually aren't changing that quickly, but it is good to know that you have access to these reports more regularly, and it's absolutely a good thing to keep an eye on. The officially recommended place to do so is annualcreditreport.com. When you pull that site up, this is what you should see on the screen. There's a lot of imposter sites out there hoping that you maybe miss a letter or do something not quite right. So going directly to annualcreditreport.com, look for this logo in the top left-hand corner stating that it's the source authorized by federal law. This is going to be where you're going to want to go to get all 3 of those reports all in the same place. So your credit report includes your identifying information and history of your credit accounts, any bankruptcies, collection accounts within the last 7 or so years, typically for those, as well as a list of who has access to your credit report. A credit report does not include things like income, assets, checking or savings accounts, debit card usage. It also typically does not include bills like rent or utilities. Reviewing your credit report at least once a year is a really good idea for many reasons. First of all, you want to make sure that you're aware of everything that's on there and be sure that nothing showed up on your credit report that you were not aware of or maybe forgot about, or let's be honest, maybe hoped would kind of go away and ride off into the sunset if you hadn't heard about it for a while from the creditor, maybe. It's really important to keep an eye on that to make sure that you're aware of everything that's reporting. Second, you want to make sure that everything is correct and accurate. A lot of people have inaccuracies and errors on their credit report, and the sooner you can catch those, get those resolved, the easier it will make your life when you get to a spot where you maybe need to apply for credit in the future. Reviewing your credit report can also be one way to catch identity theft. If you see accounts on your credit report that you are certain you did not open, or you start seeing multiple inquiries that you're not familiar with, you can contact the credit bureaus to place a freeze on your credit immediately and dispute those accounts that you know are not yours. And you can also file an identity theft report at identitytheft.gov if you do end up discovering that somebody's got your information and is applying for things in your name. And the last term that I really want to dive into is credit score, which is the 3-digit number that uses the information from your credit report to kind of calculate and help creditors predict how likely you are to pay them back as agreed if they choose to extend the credit that you are requesting. So basically, creditors use your credit score to measure how risky it is for them to offer you this loan or to give you a credit card with a certain available limit based on your history of managing other credit accounts. It's possible to have a 0 credit score if you have no credit history at all, but if there's anything on that report at all, the minimum score would typically be 300, which would be considered usually a poor credit score all the way through 579. Then you get to 580 to about 669, that is considered fair. 670 to 739 would be considered good. 740 to 799 being very good. And typically anything 800 and above is considered in the category of excellent. The average credit score typically varies a little bit from year to year, but almost always falls somewhere in kind of that mid-good range of 670 to 739. One thing that I really want to mention, and if you only hear one thing that I say today, I hope it is this: just because you have a high credit score, it does not automatically mean you are financially healthy. It is possible to have a high credit score while carrying a lot of debt and having no savings, just like it is possible to have a low credit score due to not having hardly any credit history, but being in a financially great spot overall where you've got a bunch of savings, you're able to pay cash for things. So I want to specify that while credit is important for many things, a credit score is not a financial health score. So we'll keep coming back to this and what I mean by this as we go, and some of the different things that you have to weigh as you're making financial decisions. But again, if you only hear one thing I say all day today, it is that a credit score is not a financial health score. All right, so we've talked a little bit about what credit is. Why does this matter to you? Why is credit important? Why are we talking about this for an hour on a January Tuesday afternoon? Credit can impact your ability to do and access a lot of things, including renting or purchasing a home, getting the lights turned on or turning on the utilities in that home in your name, your ability to get and keep some jobs. There are some jobs that will require a credit check before a job offer is extended. I know here at GreenPath, that's one of the requirements. I'm guessing maybe our friends at HU, ECU, usually financial institutions, put people through a credit check there. Sometimes this is done, or not sometimes, this is done for military clearances and a lot of government jobs. So this is something that can impact your ability to receive a job offer or keep a job in some cases. Credit can also impact your ability to open a bank account in some cases, and of course, access loans or credit cards, as well as miscellaneous other things, car insurance rates, cell phone plans, a variety of different groups, companies will use that credit score to, again, predict that risk level that they're taking on by choosing to do business with you, essentially. Your credit history can also directly impact how much you will pay to access loans or credit cards by being a determining factor in what interest rates you're offered. So not only is your credit determining if you're going to be eligible to receive a loan or a credit card or a line of credit, but it will also be used to determine what the terms of that credit offer will be. So here's an example of this. This is a chart of interest rates on a 5-year car loan as of last Friday, January 12th, 2024. I popped on and got the rates as of that date. So if we look at a 5-year new auto loan for $25,000, I don't know if you can get a new car for $25,000 these days, but let's say that you can. As you can see, the interest rates, the monthly payments, and the total interest paid vary pretty dramatically between someone who has that poor credit score and that very good or excellent score. In fact, someone with a very good or excellent score is going to save more than $7,600 in total interest paid compared to what they would have paid if that score was falling in that poor category. $7,600 is a lot of money, and I can think of a lot of things that I would rather do with that than pay additional interest charges. So this is a really prime example of why credit history matters and why focusing on getting that score as high as possible if you know you're going to be needing to access credit can really, really be advantageous. So there are a variety of different credit scoring models out there, but one of the most common ones that lenders and creditors use is what's called the FICO score, which is what we're really going to be focusing in on today because it is, again, one of the most common ones used in credit decisions. Another common scoring method used is called the Vantage model, which is what tools like Credit Karma and many of those other free credit score tools typically use. Neither score is necessarily right or wrong, but it is important to be aware that there are differences between the credit scoring models. And since many creditors use FICO if they're making a lending decision, if you've been keeping an eye on your score on Credit Karma or something like that, and you go apply for credit, there is a good chance that that score is going to be different because of the differences in scoring models. So again, neither is right or wrong, but just take things with a grain of salt, focus in on making sure that you're practicing the healthy credit habits we're going to talk about later, and be prepared for there to be some variation in the credit score. I wish that I could tell you exactly expect one score to be 10 points higher or something. I've seen it both ways. I've seen one score be higher than the other. I've seen it be lower. I've seen it be exactly the same. It's really hard to say for sure. Just want you to know to kind of take things with a grain of salt and know that you're practicing the healthy habits to get that score as high as it can be. So there are 5 factors that work together to determine what your FICO credit score is. The largest of which is payment history. So this impacts 35% of your FICO score. So making every payment on time every month is one of the very best things you can do for your credit score. Even just 1 month of falling past due on one account can have a very quick, pretty dramatic negative impact on your credit score that, of course, is going to take longer to build back from than it takes for that score to drop. So if you are ever in a situation where you are not sure that you will be able to pay a bill on time, reach out to your creditor as soon as possible to discuss any deferments or hardship programs or skip-a-pays that you may be eligible for that could help prevent you from falling past due. The second largest factor impacting your score is amounts owed, which includes what's considered credit utilization. So creditors want to see that your loan balances are decreasing over time and not hovering or even increasing over time. This can sometimes happen with student loans or finance loans if there's high interest or if the interest accruing is not enough to keep up. If the payments that are due is not enough to keep up with the interest that is accruing. The other thing that's factored in here is the number of accounts that have balances. Credit utilization falls within this, and this is specifically looking at accounts like a credit card or a line of credit where your balance could go up 1 month or down the next. Credit utilization looks at how much of your available credit limit you are using, and the more of that limit, the closer you are to the max, the more risk that appears to be to a creditor. So credit utilization is determined by adding up your revolving account balances and dividing that number by the total of your revolving limits, and that's your utilization number. The goal here is to try and keep that utilization below 30% of your limits at any time. Ideally, pay those off monthly, keep it as low as possible. For example, let's say maybe you have 3 credit cards. Their maximum limits are $2,500, $5,500, and $2,000. So your total available limits across those 3 cards is $10,000. Your goal is to keep that below $3,000 in balances. And if you can keep it below $1,000 or even lower than that, That's best case scenario. That is ideal. But if you have something to aim for, keeping it below 30% is the goal. The next factor is length of credit history, which looks at how long your credit accounts have been open. So this looks at the age of your oldest account, the age of your newest account, and then an average age of all your accounts. The longer your credit history is, the longer these accounts have been open and active and in good standing, the better that is for your credit score. One thing I like to point out here, student loans. I know that they can feel overwhelming and frustrating in a lot of ways, but as time goes on, student loans can actually help your credit score because they're often open for a very long time for many of us. So this can contribute positively to that length of credit history portion of your credit score. So maybe a small silver lining to having student loans hanging out on your credit for several years as you work towards getting those repaid. Mortgages are another one, usually looking at 15 to 30 years for a mortgage. These are all things that can contribute positively to that length of credit history by having those accounts open and being paid on for so long. The next factor is new credit, which is also known as hard inquiries. So when you apply for credit, when you reach out to a lender or a creditor and say, hey, I want to request credit from you, the creditor will typically do what is called a hard inquiry, which is when they dive deep into that credit report and credit score to, again, assess that risk and make their decision on if this is something they're going to say yes to. If you start applying for multiple new forms of credit on a pretty frequent or regular basis, this becomes a bit of a red flag to creditors because they start to wonder what's going on, that suddenly you needed a new credit card last month and now you're asking for a new loan this month. And maybe another new credit card on the horizon too. We, of course, typically all need to apply for credit from time to time, which is understood. That's part of kind of this system of credit, is that people need credit from time to time. So the key here is to just be strategic with when you do apply, limiting those hard inquiries to only when you need to access credit. Don't just, be applying just to find out if you're eligible, just out of curiosity. If you're in the checkout line at the store and they say that they can offer you a 5% discount if you apply, really being strategic with that and limiting those inquiries to when you really need it. The good news is that hard inquiries typically only remain on your credit for about 2 years. This is one of the things that remains on your credit report for the shortest period of time. So again, it's understood we'll all need to apply from time to time, but just be strategic with when you're doing those applications to limit those inquiries as much as possible. And then finally, credit mix is the last factor that impacts your credit score. So creditors want to see that you have a history of managing different forms of credit responsibly at the same time. So maybe having a credit card and an auto loan and maybe a student loan. This is one of the smallest factors impacting your score, but it can help and it should not be ignored that having a well-rounded mixture of types of credit can be valuable, can positively impact your score when they are all being managed responsibly. So, of course, all 5 of these factors weigh a little bit differently. We've got the payment history and the credit utilization and amounts owed that are a big chunk of this score. But all 5 of these factors play a role. They are all worth paying attention to, all worth keeping in mind when you are strategizing how to best use credit and how to improve that score. All right, so if you're starting from scratch, how does someone establish and or build credit history? One of the first things that I always want people to know is that building credit history absolutely positively does not have to mean going into a bunch of debt. It is absolutely possible to build positive credit history without carrying debt balances, without paying a bunch of interest. How do you do that? I'm so glad you asked. So how you have to have experience to get a job, but at the same time, how can you get that experience without being able to get a job? Credit can feel kind of the same when you're trying to get started. Creditors want to see that credit history to measure their risk level of extending credit to you, but how can you get that credit history without someone being willing to extend credit to you? So similar to maybe getting an entry-level job to start building job experience, there are specifically credit building products that are designed to help you start building credit history with some essentially guardrails in place to help minimize the creditor's risk. So let's take a little bit of a closer look at these credit building products. So one of the ways to build credit from scratch is what's called a secured credit card, which requires a cash security deposit to open the account. This security deposit reduces the risk to the creditor because if you max that card out and don't pay, they've got the money from your deposit to cover it. People with no credit or bad credit often must start with a secured credit card to build or establish that credit. The deposits are usually pretty low on average, somewhere between, $200 to $500, somewhere in that range, but they can vary depending on the creditor. With a secured credit card, you are still required to make a monthly payment on time to build that positive payment history. Your deposit is not used to pay for your purchases. This is not like a, prepaid gift card or anything like that. And you are charged interest if you carry a balance from month to month. So it is ideal to pay the full balance off every month to avoid having interest charges. I recommend picking just one small budgeted expense you know you're going to pay for every month anyway. Maybe Netflix subscription, something that's just a little bit of money. It wouldn't be a huge balance on there. You know that when you get your statement, that payment is due, you're going to easily be able to afford to pay that balance off in full. I like to describe a secured credit card kind of like getting an apartment. You sign a lease for that apartment, and you typically have to put down at least 1 month's rent as the security deposit. The landlord is going to hold on to that deposit as long as you keep paying your rent every month, and you eventually get it back. But if you don't pay, they keep that deposit to cover that month of rent or to cover their losses if you damage the apartment before you move out. Same thing with a secured credit card. You put that deposit down, you get that credit card, you're using it, you get a bill every month, you pay that bill every month. But if, again, you max that card out and don't pay, the creditor has that deposit to cover their losses, just like a landlord may use your security deposit to cover rent or cover damages if not paid for as well. You'll typically eventually get that deposit back on the secured credit card after you've built some good history and things have been open and active and in good standing for a while. You'll usually get that deposit back, and then it becomes a regular unsecured card at that point. Oh, and Jen just put in the chat, thank you, Jen, a link for HUECU credit cards, including secured credit cards, which is absolutely worth looking into if you've not already opened one. The other thing that can be used here are secured loans as a way to build credit. So you can do typically like a share secured or a CD secured loan, which secures the loans by funds held either in your share savings account or a certificate of deposit that are then used to allow you to build credit history. So the same thing here, you make the monthly payments on this loan as agreed, you're building that positive history, you've got an open active account reporting. But if you were to, miss a payment or stop paying as agreed, the credit union then has permission from you as the loan opens to take those funds in your savings or CD to cover the loss and reduce that risk there. Another option here, and this is something that I encourage exercising immense caution on if you consider this, but if someone you trust has a credit card in their name, they could add you as what is called an authorized user to start building some credit history. Typically, the accounts where you are an owner will have more impact on your credit, but being added as an authorized user can be a good way to start establishing some history. The reason I encourage you to be cautious here is that there is some risk in this because if the individual maxes their card out or if they miss a payment, this can negatively impact your credit as well. So this is someone that you want to trust is going to keep their balances low, is absolutely positively going to make their payment on time every month so that you're establishing positive credit history, not having negative credit building if you are attached to someone else's account as an authorized user. But again, encourage you to work towards establishing some credit history on an account that you are an owner on as soon as possible, because you've got the control there and it will typically have more impact on your score there. If you're in a situation where you've maybe had credit history in the past and then life happened, your credit suffered, you're now looking to rebuild positive credit or clean up your credit is a phrase that we hear a lot. Please know that it is absolutely possible to do so. It will require a little patience, but some of the same strategies we just talked about to build credit from scratch absolutely apply to rebuilding credit after something like a bankruptcy or a foreclosure or repossession or, a variety of collection or charge-off accounts that may have hit your credit, or if you just simply haven't used credit for 5 or 10 years or longer. So one key thing here that is a little bit different is if you're looking to rebuild positive credit history and you still have outstanding balances owed, prioritize getting those paid off. If you've got collections or charge-offs, which a charge-off is when an account falls far enough past due that the creditor begins attempting to collect the full balance owed instead of just the amount past due. This is essentially a collection account and usually is referred to as a charge-off when it's still with the original creditor before it maybe goes to an external collection agency. Work on a plan to get these balances paid off. So if you've got outstanding past due balances, this is going to be important. It's possible to improve your credit with outstanding past due balances hanging out, but it's going to be much more challenging to do so, and you can really only go so far with those balances holding you back. And then after that, and hand in hand with that, really, the same credit building products we just talked about, secured credit cards, credit building loans, potentially being added as an authorized user. These are all the same tools that you'll want to use to start rebuilding that credit as well. Typically, you can start using a secured credit card and or maybe a credit building loan while working on paying off those old balances. I recommend doing that hand in hand if you can. Start building that positive new credit history while also working on clearing up those old obligations holding your credit back as well. Kind of doing that hand in hand can be really, really valuable to getting you headed where you want to be with that credit score sooner rather than later. All right, moving in to talk about some credit myths here. So part of the reason that building credit can feel a little overwhelming is that there's a lot of conflicting information out there, and some of that information is just flat out not true. Let's take a look at a few of the most common credit myths that we hear a lot and why they're not necessarily true or are not necessarily true for everyone. So the first one is that the most common credit score myth that we hear actually is that you have to carry a credit card balance from month to month in order to build credit. Not only is this not true, but this is a myth that can actually cost you money. So when you get your credit card statement every month, there is a statement balance and a minimum payment due. To avoid a late payment, to get that positive payment history kind of check mark on your credit, all you have to pay is at least that minimum payment due by the due date. However, if you only pay that minimum payment and there's a difference between that payment amount and the statement balance, when that next statement cycles, you'll typically owe interest on that statement balance amount you did not pay. So let's say, for example, your statement balance was $50. You used your credit card to fill up the car with gas. It cost $50. Your minimum payment due was $20. If you pay that $20 by the due date, you've made your payment obligation, you get that check mark. Yes, you paid on time. You built that positive payment history for this month. But when your next statement cycles, you would typically be charged interest on that $30 difference. But if you pay that full $50 statement balance by the due date, typically you're not going to be charged any interest there, and you're essentially starting back over at zero on that next statement cycle. Some people have been told and believe that they must only pay that minimum payment and make sure that they carry a balance into the next month to build credit. And that's simply not true. I can tell you, I have credit card, I pay my balance off in full every month. My credit score is in a pretty good spot. So I can assure you that you do not have to carry a balance from month to month to build credit. I strongly encourage you to get in the habit of paying off the entire statement balance you owe in full when you get your statement each month. This saves you money on interest charges. It also helps you keep your balance lower, which can improve that credit utilization we've talked about. Just try not to think about credit cards as extra money. Try to think about them as a strategic tool that can help you build this credit history. The next one here is opening a new credit card every time I get an offer is a good thing for my credit score because you need a lot of credit cards to build credit. So technically, having more available credit limit can help improve your credit utilization, but this is a dangerous game to play. So when you open a new credit card, you've got a new hard inquiry, you have a younger account in your length of credit history, both of which can negatively impact your credit score. Also, the more credit cards you have, the trickier it can be to keep track of those due dates, make all of those payments on time. And honestly, the more potential there is for you to get in a little bit over your head if you've got balances spread out across multiple cards. You might not realize how much your total outstanding balances are if you've got several accounts that maybe don't have terribly high balances, but when you start adding it up, you might get in over your head a little bit quicker there. So this one is not necessarily not true, but it is one that I really encourage you to be strategic with. There's no magic number of credit cards that is best to have, but here at GreenPath, we typically recommend trying to keep that to around 2 or 3 at the most. Also, I encourage you to remember that having a mix of types of credit open helps your credit score as well. So having maybe a couple of credit cards and maybe a loan of some type. This can help improve your credit mix more than just having multiple credit cards as well. The next one here that we also hear a lot is I should close a credit card after paying it off if I do not plan to use it anymore because this will improve my credit score. So again, some people think that they should pay that card off, they should close it, this is going to help. This can actually negatively impact your credit score. So you will lose that length of history from that card. It can impact your utilization because that available credit comes out of the mix. So from a credit score standpoint, once you open a credit card, it is best to keep that open as long as you're managing the card responsibly. Even if you don't plan to use it for much, consider setting up a small recurring expense like a monthly subscription and then set up an automatic payment so you know it's going to get paid on time every month. From a credit score standpoint, that is what is best. However, you may remember earlier that I mentioned that sometimes you have to weigh that credit score versus the financial health piece. So if keeping the credit card open is going to be a temptation to rack up the balances, or you know that you'll fall behind on payments, you know that having this credit score open, or I'm sorry, this credit card open is not a good move and not wise for your financial health, by all means, close that card. You have to weigh the pros and cons like this and do what's best for your finances across the board. So yes, closing that card may have some initial negative impact on your credit score, but carrying a high balance, being late on payments, these things will typically have a much more substantial negative impact that usually lasts longer. So like we talked about earlier, credit score is not a financial health score. This is a prime example of sometimes having to take a little bit of a credit score hit potentially to maintain your financial health and help that credit score be in a stronger position across the board. Next one here, we talked earlier about reviewing your credit report and the differences in credit score monitoring tools. We also talked about how applying for credit leads to a hard inquiry, which can start to negatively impact your credit score. So some people believe that checking their own credit will also hurt their credit score. So there are 2 different types of credit inquiries. The hard inquiry, which is what's done when a creditor or lender is diving deep into that credit history to measure that risk level of extending credit. A hard inquiry is the one that can indicate that you have applied for credit, and as we discussed earlier, can start to negatively impact your credit score if done too often. However, when you check your own credit for educational or monitoring purposes, this is what's called a soft inquiry, and it does not impact your credit score. Here at GreenPath, we offer credit report reviews. We do soft pulls of credit report on a regular basis, and it's something that's really important to do. Again, review your report, keep an eye on your score so you can react quickly if you notice fraud or something doesn't seem right. And the good news is that you are absolutely free to do this and encouraged to do this without having to be concerned about it impacting your credit score. All right. As we wrap up today, if you've got questions, please do put those in. We're going to have plenty of time to get those answered. But whether you're building credit history from scratch, whether you're rebuilding credit following a setback, or just want to continue to maintain a good credit score, I want to just wrap up our time together by talking about some healthy credit habits that are important to put into practice. The first of which being, as we discussed earlier, making every payment on time every month. Payment history, once again, is the largest factor that impacts your credit score. Missing or being late on just one payment can again have a very quick, very negative impact on your credit score, and it will take a while to build back from that drop. When I counseled here at GreenPath, people would call me kind of in a panic mode saying, I was just a few days late on just one account. Surely it could not have impacted my score that much, but it really can. So this is why it's so important to make every payment on time every month. If you're concerned about keeping track of due dates, absolutely recommend setting up automatic payments so you make sure that those bills are getting paid on time every month. If you have student loans, this is something that's especially important right now. If you're not still in school, if you're not in deferment, if those payments were expected to resume this fall, take a look at that. This is something that 40% of people who were expected to resume their federal student loan payments in October did not. So take a look at that. If you're thinking, oh, I wonder if I was supposed to, log into your student aid account, take a look at that, work on a plan to get things back on track. If you are still in school, make sure that you're communicating with your loan servicer and getting those payment arrangements in place before those payments start being due. With federal loans, you typically get a 6-month grace period after you leave school before those payments start being due. So this gives you some time to get those arrangements in place, making sure that you are prepared for those payments to start and start building that positive payment history at the time that those payments begin being due. We also mentioned credit utilization, or where your credit card balance is compared to the maximum limit. And this is, again, the second largest factor impacting your score. So encourage you to strive to always keep your balance below 30% of the card's maximum limit. If you can keep it below 10%, even better. Best case scenario, ideal state, pay that card off in full every month. Again, I encourage you, pick one small specific budgeted expense to use your card for. Use that card just for that purpose. Don't carry it with you necessarily. Just, have it set up for that recurring subscription or whatever that looks like. Keep the balance low and then pay that full balance off when you get your statement for the month. This is a great, great, great way to build positive payment history while keeping a low balance and avoiding interest if you pay that full statement balance off monthly. The other one here, again, not applying for credit until you need it. Again, most of us are going to need to apply for credit from time to time, which is understood, which is expected. Just be sure to be strategic when you do, instead of frequently applying for accounts you don't necessarily need, because that can start to negatively impact your score. One thing that I do want to mention here, if you're in a situation where you're maybe applying for like a mortgage or an auto loan and you want to shop around to make sure you're getting the best rate, get all your ducks in a row and apply with multiple lenders in a short time period. And that would typically lead to it counting as one hard inquiry instead of multiple. This allows you the chance to make sure you're getting the best deal without having more impact to your credit score. You'll see all of those inquiries still listed, but when it comes to the credit score impact, if it's in a short time period for the same type of account, it would typically not have the impact as if you were to apply for a mortgage tomorrow and then decide you're not ready, but March rolls around and you see, a dream house on Zillow and you want to try again, applying then, and then kick that can down the road till the summer. If you're spreading that out, that can have the negative impact of multiple hard inquiries. The other thing here that I really want to encourage you is to not ignore bills. Even if you think it's an error or you already paid it or this is something you don't think that you should owe, collections can stay on your credit report for up to 7 years and can have a quick negative impact on that score. I have seen everything from car insurance, cell phones, cable or internet equipment that wasn't returned, medical bills, rental leases broken early, and a variety of other things have been sent to collections and weigh heavily on someone's credit. When I counseled here at GreenPath, people would tell me all the time that I could just ignore that collection because it shouldn't be on there, because that bill was paid or it was an error or they don't owe it for some reason. Unfortunately, that's not really how it works from a credit score standpoint. We can't really ignore that. It's impacting that score. So taking care of this as soon as you get a past due bill or a notice is so, so, so important. Ignoring it because you don't think it's legitimately typically will not make it magically go away, but it can make it much harder to take care of later while also weighing heavily on your credit score. An example of this, I have a medical bill that I paid through my health savings account December 5th. And I got an email today from the healthcare provider saying that it's past due. So I'm going to be on the phone with the healthcare provider over my lunch break later today saying, hey, I paid you all a month and a half ago because I don't want that going to collections. I don't want the headache of having to deal with this. So I know I paid it. It could be easy to just say, oh, I paid it. I don't have to worry about it. Clearly that's an error. But unfortunately, it doesn't magically work that way. So if you get into a similar situation, you receive a past due bill or a notice or something, even if you know it's not right, take a little bit of time, do the legwork, work on getting it resolved before it becomes a bigger headache, a bigger hassle for you by being sent to collections essentially. And then again, reviewing your credit reports from annualcreditreport.com at least once a year. Again, you're able to do that more frequently now, but encourage you to make sure you are doing that at least once a year to make sure everything looks correct, make sure you're aware of everything that's on there, and then taking action to dispute anything that is inaccurate as soon as possible is going to be advantageous for you as well. And then finally, did I mention making every payment on time every month? This is something that is worth repeating because it really makes a huge difference when it comes to your credit. And this is the best tip that I have for you is really prioritizing that. All right. So as we wrap up today, I mentioned GreenPath earlier as a nonprofit credit counseling agency. If you want to take a closer look at your specific credit situation, you are invited to reach out to GreenPath for a free confidential financial assessment. So through GreenPath's partnership with HUECU, we provide a variety of services, all designed to empower people, including you, to lead a financially healthy life. So a financial assessment is basically just a conversation that starts out with figuring out where you're at right now financially, what your financial goals are, where you want to be, and then working with you to create an action plan that you can put in place that you're confident in being the way to get where you want to be. So we'll talk about pros and cons of different options that make sense for your situation. We'll equip you with the education and the information you need to determine the best path forward to get where you want to be. We're a nonprofit. This is not a sales pitch. We're here to help you. We're here to support you and give you a little bit of guidance on coming up with a plan to get where you want to be. Specifically in regards to credit, which is what we talked about today, we can do a soft pull of your credit with you and review that in detail. We can give you specific tailored advice on how to improve your credit score based on your actual credit history. There's so many moving pieces coming into play with credit, and everyone's situation is different, like we've talked about. You and I could pay off the same account on the same day, and it would probably have different impacts on our credit scores. So if you're in a situation where you really want to improve your credit or you want to understand what's impacting your specific score, give us a call for a free credit report review to get some clear, specific advice based on your actual credit history. We also offer a free online financial education platform with a variety of interactive courses that you can take 24/7. So there is a link in the chat that Jen put in there to information about GreenPath on the HUECU website. If you go there and click on the Learning Lab Plus button, there is an A1 credit tool course. It's only about 10 minutes, but it's an interactive course to dive deeper into the topic of credit if you would like to learn more. And then if you want to call and talk to one of our counselors, dive deeper into your financial situation or do that credit report review, you can give us a call at 877-337-3399. We're here until 10 p.m. Eastern, Monday through Thursday, until 8 p.m. Eastern on Fridays. And Saturdays, we're available by appointment from 9 a.m. to 2 p.m. as well. When you give us a call, let us know that you were connected through HUECU, even if you're not a member yet. Hopefully you will be soon, but you heard about us through HUECU, so please let us know that when you reach out so that we can make sure that you've got full access to everything that we offer through our partnership. All right, now I think we have some questions to answer, hopefully. If you've got questions, please do share those in and let's spend some time getting those answered for y'all.
Wow, thank you so much, Amber. That was really great. I feel like even I learned some stuff, and I've done credit presentations myself, so very, very involved. I did have a couple questions here that were submitted during registration. I think you covered most of them, but there's a couple here that I think might be good to kind of speak to if there's something you might add, which is let's start with this one, which is how does credit work for international students, and what do they need to pay attention to?
Yeah, so this can be a little tricky, especially if you've maybe, been coming from another country that has a different credit system. One of my coworkers on our team is British. She spent most of her adult life in the UK and came to America and had to basically start from scratch, which was frustrating because her and her husband had amazing credit in the UK, and then they came here and couldn't buy a house, even though they, had this amazing history. So it is a situation where you're really going to want to focus in on those same building credit tools, the secured credit card, the credit building loan, practicing these habits, just establishing that presence, establishing that credit history within essentially the US credit system, for lack of a better explanation of it. So everything that we talked about today, relevant and applicable to you as international students as well.
Wonderful. Awesome. Okay, and then another one here we had was what's the best way to work on repaying debt in a way that least impacts my credit score? So say you have like a lot of outstanding debt with different interest rates, stuff like that. Like, what's the best way to kind of start tackling that?
Great question. So perfect world, win the lottery, or come up with a bunch of cash and be able to pay it all off at once, but that's not happening for most of us. So I would say, really diving into your financial situation is going to make that answer vary. So if you're in a
Mm,
situation where paying off the debt is a top priority for you and getting that credit score improved is your number one priority, take a look at your budget and spending plan and see if there's some changes that you can make, even if it's just temporary. You don't have to give up your all your streaming services or eating out forever. If it's something that you can commit to doing for a short time period and putting that money towards getting the debt paid off a little bit more aggressively, great. I know this is easier said than done for a lot of busy people, but picking up a side gig or finding some ways to get a little bit of extra cash coming in. Again, this does not have to be a forever commitment, but if this is a goal, if this is something that you want to prioritize, think about what makes sense. Does it make sense to find a way to bring more money in? Or does it make more sense to find a way to cut expenses to have more cash to put towards this debt more aggressively? There are also other options that may be helpful here. Talking to the credit union about maybe a consolidation loan or something like that that could maybe get those rates lower and help maybe your payment be a little bit more affordable, but with a lower interest rate, make it more possible to get that debt paid off a little bit more aggressively. GreenPath offers debt management plans, which can be a good fit in some cases as well. So, if this is something that you want to dive more into, we would love to talk to you at GreenPath, or HUEC would love to talk to you. This is one of those situations where taking a look at your unique situation to give you the best guidance possible is going to be important. So, we're here to help. Reach out. It's free, it's confidential to talk to GreenPath, and we'll talk through pros and cons of any option that makes sense to you to get that debt paid off. And then equip, educate, and empower you with what you need to be able to make a decision on what's best for you.
and make your payments on time and in
Yes.
full.
Yes.
Great. Okay, well, I'm not seeing any other questions at this time. I'm just going to kind of go over a few HUECU details on our way out here, but thank you everyone so much for attending today. If you do have any questions after this presentation, or as Amber said, would like to follow up on your exact specific situation, GreenPath is going to be great for that. Please feel free to make use of their services. Um, and thank you. Please stay in touch. We're going to have a survey uh, following this webinar. We at the credit union really do like to make sure that we're listening to our members, our community. So we do read each and every survey. So please, if you have a moment, a couple minutes, just please fill out that survey. Keep in touch with us. We have a lot of social handles as well, including blog posts, our YouTube page where this video and all of our other sort of financial topic videos will be available for review at any time. So please stop by the branch if you get the chance. We'd love to see students in there. So thank you everyone so much for coming today. I hope
Thank you.
everyone has a great day. And thank you, Amber, for being an
Yeah.
expert for us.
Yeah. Thanks, Ty. Thanks for having me.
Bye, everyone.